What if the biggest threat to America's financial power is not a war, not a recession, but a strategy the United States once used to take control of the world itself? And what if China has been following that strategy for years, while most people are still arguing about headlines and missing the deeper game? If you like videos that connect hidden dots before everyone else sees the picture, hit like, subscribe, and share this with one person who loves sharp ideas. Most people think global power changes when armies move. That is the movie version. The real version is quieter. It happens in banks, in trade deals, in gold vaults, in shipping routes, in payment systems, and in the small choices countries make when they decide which currency they trust. That is where empires rise. That is where empires fade. And once you see it, you cannot unsee it. Because this is not just a story about China getting stronger. It is a story about China studying the exact moment another old power got replaced, understanding why it happened, and then using the same logic against the country that wrote the original playbook. Back in the early 20th century, the financial center of the world was not New York. It was London. The British pound was the currency that moved through global trade. British banks financed deals across continents. If two countries did business, there was a good chance London touched the transaction. Britain had reach, credibility, and a system the world was used to using. That is what real monetary power looks like. It is not just wealth, it is dependence. It means everyone else builds their routines around you. Then history opened a door. 2 world wars shattered Europe. Britain spent its strength trying to survive. America did not come out of that era untouched, but it came out with something much more valuable than survival. It came out with leverage. The United States had massive industrial power. It had rising financial influence. It had gold, it had creditor status, and most important of all, it had the ability to propose a new order at the exact moment the old one was too weak to defend itself. That is why 1944 matters so much. At Bretton Woods, while the Second World War was still not fully over, leaders were already thinking about the system that would come next. The dollar was placed at the center, other currencies were linked to it, the dollar was linked to gold. America did not simply win a conference, it locked in a structure. It turned wartime advantage into long-term financial rule that shaped the world for generations. People often talk about that moment like it was sudden. It was not. The conference was the final scene. The setup had been happening for years. America had become a major creditor. America had built trust in its financial system. America had accumulated the hard assets that gave its promises weight. America had created alternatives to the old British-centered world, and then America waited for Britain to hit the point where it could no longer protect the system it once controlled. That is the pattern. Now here is the part almost nobody says clearly enough. China does not need to invent a new formula for global power. It only needs to repeat an old one under modern conditions. And that seems to be exactly what it is trying to do. Not with the same language, not with the same institutions, not with the same ideology, but with the same strategic logic. First, build influence through lending and trade. Second, reduce dependence on the current system. Third, create alternative infrastructure. Fourth, accumulate assets that cannot be frozen or manipulated by a rival. Fifth, wait for the dominant power to weaken itself. Then, when the moment comes, be ready with a new arrangement. If that sounds dramatic, look at the pieces one by one. For more than 2 decades, China has been turning itself into the central trading partner for huge parts of the world. That alone matters more than many people realize. Money follows trade. Systems follow volume. When enough countries depend on your factories, your ports, your financing, your supply chains, and your market, they start asking a practical question. Why should every transaction still run through someone else's currency and someone else's financial rails? China's Belt and Road push is part of that story. People argue about whether specific projects are wise, wasteful, strategic, or predatory. Fine, those debates matter. But step back and look at the larger effect. China has spent years building roads, rail links, ports, power projects, and logistics networks across Asia, Africa, Latin America, and parts of Europe. That creates more than physical infrastructure. It creates relationships. It creates bargaining power. It creates habits. And habits are powerful in finance. A country that owes money, needs refinancing, wants more investment, or relies on your market becomes more careful about confronting you. It may not become loyal, but it becomes cautious. That caution is political value. America understood this a century ago. China understands it now. Then there is the creditor issue. People often speak about debt like it is only a domestic problem, something measured in angry election speeches. But debt is also a geopolitical relationship. A country that keeps borrowing must keep confidence alive. It must keep buyers interested. It must keep the story believable. When the United States was rising, it used creditor power to gain influence over weaker states. Today, China has spent years lending abroad while America's own debt burden keeps growing, and this is where the comparison becomes uncomfortable. The United States still has enormous strengths. Its capital markets are deep. The rule of law is stronger than China's in the eyes of many investors. The dollar is still dominant in reserves, payments, and debt issuance. According to the Federal Reserve, the dollar still made up about 58% of disclosed global foreign exchange reserves in 2024. That is a huge lead. It is still involved in the overwhelming majority of foreign exchange transactions. This is not a collapse story, it is an erosion story. And erosion stories are dangerous because they feel slow right up until the structure suddenly looks fragile. That is exactly what happened to Britain. The pound did not vanish in a weekend. Its decline took years. Many smart people in London could see the pressure building. But seeing pressure and stopping pressure are not the same thing. Once debts rise, once industrial leadership slips, once overseas commitments expand, once rivals build alternatives, time starts working against the incumbent. That is why China's moves matter even if the renminbi is still small compared with the dollar. China is not trying to win the whole game tomorrow morning. It is trying to make tomorrow less American than yesterday. That means it does not need a full replacement yet. It just needs enough countries to settle more trade outside the dollar, enough institutions to use parallel systems, enough central banks to question how safe dollar reserves really are, and enough evidence that the current order can be weaponized when Washington chooses. That last point became much more important after recent sanctions on Russia. When hundreds of billions in Russian reserves were frozen, many governments learned a brutal lesson. Holding assets inside the dollar system is not the same as holding neutral wealth. It may be safe. It may also be vulnerable if your relationship with the United States turns hostile. Whether one supports those sanctions or not is not the key point here. The key point is what other countries learned from them, and China definitely learned. That helps explain the next piece of the strategy: gold. Gold sounds old-fashioned until trust gets political. Then gold starts looking modern again. Gold does not depend on another state's promise. It cannot be printed by a rival central bank. It cannot be sanctioned in the same way as a digital reserve sitting inside someone else's financial system. That is why countries that worry about financial pressure often become more interested in gold, not less. China has been steadily adding to its official gold reserves. Reports from the World Gold Council noted that after May 2026, China's official gold holdings stood above 2,300 tons, following 19 straight months of additions. Some analysts believe the real total controlled through broader state channels could be higher, though exact numbers are debated. The precise hidden figure matters less than the visible message. China wants optionality. China wants insulation. China wants a reserve base that does not depend entirely on trust in the dollar order. That does not mean China is going back to a classic gold standard. It means China understands the psychology of reserve power. If the world ever moves into a period of deep monetary distrust, countries with hard assets have more room to maneuver. Now look at infrastructure, because this may be the most important part of all. Quick check before we go deeper. If this breakdown is helping you see the global chessboard more clearly, subscribe now, like the video, and send it to someone who still thinks reserve currencies change only because of military headlines. Power is strongest when it feels invisible. If everyone uses your pipes, your switches, your settlement systems, your standards, and your language of payment, they stop noticing your power because it feels like normal life. That is what the United States built after World War II. The dollar order became so embedded that most people now confuse it with nature. China is trying to build the early version of its own parallel architecture. Not a complete replacement, not yet. A fallback, a side door, a growing second lane. That is where systems like CIPS matter. China's cross-border interbank payment system is often described too simply as a rival to SWIFT. It is better understood as part of a broader effort to expand renminbi settlement and reduce vulnerability to Western-controlled financial channels. As of April 2025, CIPS had 171 direct participants and 1,500 indirect participants spread across 119 countries and regions. That does not make it king, but it does make it real, and real matters. Because once a backup system exists, countries under pressure start considering it. Countries wanting bargaining power start considering it. Countries that trade heavily with China start considering it. Every new connection adds a little resilience to the non-dollar side of the board. Then there is energy. For decades, one of the strongest pillars under dollar dominance has been the fact that key commodities, especially oil, have mostly been priced and traded in dollars. That creates automatic demand for dollars. If you need energy, you need the currency that buys energy. That is a huge advantage. China understands that too, so it has been encouraging more trade settlement in its own currency, including energy deals where possible. Russia and China have already shifted large portions of bilateral trade away from the dollar. Other countries have explored local currency trade arrangements. Saudi Arabia has not led some giant public revolution away from the petrodollar, but even limited openness to non-dollar settlement matters at the symbolic level. This shows the old structure is no longer beyond discussion. That is how these shifts begin, not with one dramatic announcement, with a series of exceptions that slowly teach the world a different habit. And habits, once formed, spread. Now let's deal with the biggest reason this strategy has a chance to work. It is not just that China is building. It is that America is drifting. This is the most painful part of the comparison because it has less to do with Beijing's genius than with Washington's inability to correct obvious weaknesses. The United States has extraordinary assets. It remains richer, more innovative, and more financially central than any rival in many areas. But it is also running an astonishing debt load. Broad public debt measures are now around $39 trillion. Interest costs have surged as rates rose, with official U.S. fiscal data showing debt maintenance costs in the hundreds of billions and climbing fast. That does not mean default is around the corner. It means fiscal flexibility shrinks when borrowing becomes normal and expensive at the same time. Britain faced a version of that trap. It still had prestige after the wars. It still had networks. It still had talent. What it lacked was room. Room to finance. Room to absorb shocks. Room to impose its will without asking for help. That is what debt can silently destroy. Not status first, options first. And once options disappear, status follows later. China seems to understand this perfectly. It does not need to crash the dollar. In fact, crashing the dollar too quickly would hurt China too. Beijing still benefits from access to the existing system. It still holds dollar assets. It still relies on global trade stability. So the likely goal is not destruction. It is gradual repositioning. In plain English, China appears to be saying, keep using the current order while building the next one. Keep trading inside the dollar world while reducing the cost of leaving parts of it. Keep accumulating influence while America spends political energy fighting itself. That is a patient strategy. And patience may be China's biggest edge in this contest. American politics often thinks in election cycles. Chinese state planning often thinks in decades. That does not mean China always executes well. It makes mistakes. It faces major internal problems. Its property sector has struggled. Its demographics are ugly. Youth unemployment has been a concern. Capital controls make foreigners cautious. The renminbi is not freely trusted the way the dollar is. These are serious limits, and they matter. That is why anyone saying China will simply replace the dollar next year is talking nonsense. But that is also not the claim. The real claim is more subtle and far more plausible. China is building the tools it would need if a future crisis opens the same kind of historic door. That door is the one America walked through in the 1940s. That is a very different statement. Because reserve currency transitions do not require the challenger to become perfect. They require the incumbent to become less convincing. Read that again, because it changes everything. America did not overtake Britain because the United States had no flaws. It overtook Britain because the balance of credibility, production, leverage, and resilience shifted enough that a new structure became easier to imagine. Once the imagination changes, institutions follow. So what would China need for a real breakthrough? Not total global trust. It would need broader regional trust. Not full renminbi dominance. It would need larger renminbi usage and trade. Not universal adoption of its systems. It would need enough adoption to make exclusion from the dollar order less terrifying. Not a sudden end to dollar demand. It would need steady diversification at the margins. And those margin shifts are already visible. The dollar's share of official reserves has declined from levels above 70% around the turn of the century to the high 50s more recently. The renminbi is still small, around 2% of disclosed reserves, but the point is not the number alone. The point is that more countries are thinking in terms of diversification. More are hedging. More are asking whether the post-1945 system will still feel secure in a world of sanctions, rivalry, fragmentation, and rising debt. That question is the opening China needs. It also helps that many countries in the global south do not want to choose between America and China in a moral drama. They want flexibility. They want investment. They want access to both markets. They want room to negotiate. If China offers financing, trade, payment channels, infrastructure, and a political message built around reducing dependence on the West, that message will appeal to some. This applies even if they distrust parts of China's model. Again, this is very similar to what the United States once did in its own way. Rising powers attract others not only with ideals, but with practical alternatives. And practical alternatives change the map faster than speeches do. There's another layer almost nobody talks about enough, and it may be the deepest one of all. Reserve currency power is not just about economics. It is about psychology. The world uses a dominant currency because it trusts that everyone else will keep using it. That is what creates the loop. Central banks hold it because markets trust it. Markets trust it because central banks hold it. Traders price in it because liquidity is deep. Liquidity is deep because traders price in it. This is not just math. It is shared belief reinforced by institutions. That means the first real crack in a reserve system often appears in narrative before it appears in statistics. People start talking differently. Officials start planning differently. Contracts start allowing more flexibility. Central banks start buying a bit more gold. Trade partners test settlement in another unit. Sanctioned states build workarounds. Non-sanctioned states study those workarounds quietly. And one day, a structure that looked permanent starts looking political, expensive, and maybe less neutral than advertised. That is why America's use of financial power is both a strength and a risk. Sanctions, export controls, secondary restrictions, and the unmatched centrality of dollar finance give Washington enormous leverage. But every use of leverage also teaches others why dependence can be dangerous. The more the system is used as a weapon, the more incentive rivals and fence-sitters have to build armor. China sees that. Russia sees that. Iran sees that. But so do countries that are not enemies of the United States and simply do not want their options tied to one power. This is where many Western analyses still fall short. They ask, can the renminbi replace the dollar today? That is the wrong question. The better question is, can China help build a world in which the dollar matters less than it used to? Those are not the same thing. The first requires supremacy. The second requires dilution. Dilution is easier, and dilution may be enough to change geopolitics in major ways. If you are still with me, drop a comment with one word, slow or sudden, for how you think the next monetary shift will happen. While you're there, tap, like, and subscribe so more people find this conversation. Imagine a world where the dollar is still number one, but no longer overwhelmingly so. A world where more oil, minerals, machinery, and regional trade are settled in mixed currencies. A world where central banks hold a little less in dollars, a little more in gold, and a little more in alternative assets. A world where countries under U.S. pressure have more escape routes than they had before. In that world, Washington still matters enormously, but its ability to set global terms weakens at the edges first, then more broadly over time. That edge weakness is how dominance fades. Britain did not wake up one morning and discover the pound had become irrelevant. It discovered gradually that defending old privileges was getting harder, more expensive, and less realistic. Then one day the new arrangement was formalized, and a long shift suddenly had a name. If history rhymes here, China is not trying to schedule a single dramatic replacement ceremony. It is preparing for the day a crisis forces the world to reconsider the rules. Maybe that crisis comes from debt, maybe from war risk, maybe from inflation, maybe from a banking shock, maybe from repeated sanctions that push too many countries to seek distance. Nobody knows the trigger, but the trigger is not the strategy. The preparation is the strategy, and China has been preparing, building trade webs, extending credit, adding gold, creating payment rails, promoting local currency settlement, making itself harder to isolate. Watching the U.S. debt trajectory worsen, waiting. That last word matters most. Waiting is hard for democracies because voters feel today. They punish pain now, not risk later. Waiting is easier for a state that is willing to absorb friction for long-term positioning. China does not need every year to look beautiful. It needs the direction of travel to keep improving relative to America's. And what is America doing while this happens? Often arguing about symptoms while ignoring structure, arguing about trade deficits without rebuilding enough industrial resilience, arguing about debt ceilings without treating debt growth as a civilizational problem, arguing about China's rise while still depending on Chinese-linked supply chains in critical sectors, arguing about national strength while allowing political dysfunction to erode the one thing reserve systems need most: confidence in the future. Confidence is not patriotism. Confidence is not flag-waving. Confidence is the belief that the system can govern itself well enough to deserve long-term trust. That is the heart of this entire story. Because in 1944, America did not simply have gold and factories, it had momentum. It looked like the future. Britain looked like the past. Financial orders change when the world decides where the future seems to be. So ask yourself an uncomfortable question. If a neutral country had to bet on which power looks more capable of playing the long game right now, which answer would feel safer? The United States still has better markets, better legal protections, stronger alliances, and greater financial depth. Those are huge advantages. But advantages can be wasted. Britain had advantages too. They were real, and still not enough. The danger for America is not that China becomes perfect. The danger is that America keeps assuming it does not need to become better. That is how dominant powers lose position. Not because they are instantly beaten, but because they confuse current size with permanent safety. Here's the final point, and it matters for every person watching this. This is not only about governments. If the world moves even part of the way China wants, the effects reach ordinary people. Reserve currency status helps America borrow more cheaply than it otherwise could. It supports demand for dollar assets. It reinforces U.S. influence over global finance. If that privilege weakens over time, the consequences could show up in inflation pressure and higher borrowing costs. It could mean reduced sanction power, more unstable capital flows, and a world where financial shocks spread in new directions. For investors, businesses, and workers, this is not abstract. It shapes what money costs, where factories go, which alliances hold, and how crises get managed. That is why the story matters so much. China is not just rising. China is studying succession. It is studying how one order replaced another. It is studying how to be ready before the old order realizes the real contest has already started. And maybe the most unsettling part is this. The United States knows this history better than anyone. America lived it. America mastered it. America used it to become the center of the modern world, which means if China is really repeating that strategy, then the warning signs are not hidden. They are painfully familiar: a rising creditor, a patient industrial state, a push for parallel systems, a steady move into hard assets, a campaign to deepen trade dependence, a dominant power sinking deeper into debt while assuming its lead is untouchable. That is not random. That is a pattern. And patterns matter most when proud nations refuse to see themselves inside them. So no, the dollar is not about to disappear. No, China has not already won. No, a new Bretton Woods is not scheduled on the calendar. But yes, a long strategic contest is underway. Yes, China is building many of the ingredients that once helped America replace Britain. Yes, the United States is exposing vulnerabilities a patient rival can exploit. And yes, by the time most people admit the game changed, the hardest moves may already be over. That is how history usually works. Not with a trumpet, with a shift, then a delay, then a realization, then a new map. The real question is not whether China wants a 1944 moment of its own. The real question is whether America will recognize the pattern early enough to stop handing one to them